When I say SPACs are scam, I'm not exaggerating or trying to create a clickbait.
SPACs generally have to spend their money in 2 years, as I understand it. So they have to buy a business in 2 years. If you put a gun to my head and said you got to buy a big business in 2 years, I'd buy one.
The whole idea of SPACs is specifically designed to benefit the sponsor of the SPACs, and it is completely stacked against small investors like you.
It's a different equation that you have if you're working with other people's money, where you get the upside and you have to give it back to them if you don't do something.
And in this video, I will explain to you exactly how SPACs work and how are they built to steal the dollar bills from your pocket. My name is Kanak and welcome back to my channel. If you haven't already, then subscribe to my channel for informative and interesting content. SPACs are also known as blank check companies, and yes, the real name itself sounds very fishy. When you invest in SPACs, basically you're investing in a shell company. That means you're not investing in any concrete business, but rather you're just handing over your money to the fund manager who is issuing the SPAC. And when the SPACs are issued, usually there is no specific commitment or investment plan that is shared with the investor. You're simply trusting that the sponsor or the fund manager of the SPACs will go out, find the right business to invest in, and increase your wealth more than what you would have made by investing in the S&P 500 index. You will realize that the real scam starts when you look at how the sponsors of the SPACs make money from retail investors without showing any track record of performance. Once the SPACs raise money through IPO, the fund manager has 24 months to find a private business to acquire. And if they are not able to find the investment within 24 months, they will have to return the money back to the retail investors. And if the sponsor of the SPAC is able to find the business and close the deal within 24 months of issuing the SPAC, then they get 20% of the equity in the SPAC. So it does not matter whether they made the right or wrong investment decision, but if they close the deal within 24 months, the sponsors of the SPAC get to keep 20% of the stakes in the new investment. So the only incentive that sponsors have is to close deal within 24 months, because then they will get to keep the 20% of the investment. So it is like when you buy a house worth $1 million, you pay the broker $200,000 just to help you find the house. And not only that, but the sponsors get paid 3 to 5% of the IPO proceeds as fees, which is literally like paying them fees just for promise that they will go out and find an investment in the next 24 months. It is like you're paying your real estate broker 5% of your future house purchase value even before your broker begins to search for a house for you. Now, one of the biggest drawbacks of SPAC investing is that the sponsor of the SPAC decides the purchase value of the target acquisition company. Unlike publicly listed companies, where the broader market participants decide the fair value of a company based on publicly available information, the value of a SPAC acquisition is determined by a handful of fund managers, whose sole motivation is to close the deal within 24 months of raising money. Now, to achieve this objective of closing the deal within 24 months of raising the money, the likelihood of closing the deals at an exorbitant overvalued prices is very high, which again works against the interest of the retail investors. Finally, if the investments do not perform well, the sponsors of the SPACs do not pay any price from their own pockets. It is the small retail investors who will have to liquidate their SPAC and just get back whatever money that remains after the stock prices collapse. Strategists at Goldman Sachs noted that of the 172 SPACs that had closed a deal since the start of 2020, 6 months after the deal closure, median SPAC had underperformed the Russell 3000 index by 42 percentage points. SPACs have generated very poor returns for retail investors and lost money in most of the cases for small individual investors. Buying SPACs is like overpaying for an underperforming and money-losing investment, and in the process making the sponsors of the SPACs rich. If you want to invest in small and medium-sized businesses, then investing in a low-cost Russell 2000 ETF would be the cheapest and most effective investment option.